All right, this is Ubaid on behalf of Electronics, and in this video, we'll be talking about the discount rates and bank runs. Okay, so we did talk about the central bank being the lender of last resort, so to speak, because of things such as bank runs. Okay, now even though we have depositor insurance for all the clients of commercial banks, okay, those depositor insurance policies cannot stop a bankruptcy. Okay, as a result of which, if you need to stop or prevent a bankruptcy, if you need to stop a bank from becoming insolvent, okay, what you need to do is use the funds from the Central Reserve Bank. Now, these funds are not for free. Okay, the Central Reserve Bank does charge a interest, so to speak, and their interest rates are based on something called discount rates. Okay, so your discount rates are given out to commercial banks when they're on the verge of bankruptcy. Let's say they're uh, forecasting a bankruptcy or insolvency in the near future. Okay, as long as they haven't become bankrupt yet, as long as they are still financially sound to some extent and they're not bankrupt, they should be able to uh, use the central bank and use the reserves or use the funds provided by the central bank to make themselves financially stable and sound. All right. So the funds that the central bank gives out, okay, these funds are given out using the discount rate. Okay, and this is again the interest rate. This is the interest rate. Interest rate. Interest rate at which the Federal Reserve, the federal banks, Federal Reserve Bank, Federal Reserve Bank. Okay, lends money, lends money to commercial banks. Okay, and this is to prevent a bank run. All right, so that would be your discount rate. Now, obviously, this discount rate, okay, the interest rates may go up and down, they may fluctuate. Okay, so when the interest rates go up, assuming your discount rates go up, okay, the commercial banks will borrow less from the Central Reserve Bank if they can afford not to borrow, okay, from the Central Reserve Bank. So commercial banks will borrow less. Okay, and instead what they do is they reduce some of their loans. Okay, so reduce. Now remember, loans are assets. Okay, the money that bank lends out to their clients, okay, these are assets for the bank on the balance sheet. Okay, as a result of which, when they reduce their loans, they usually transfer some of that money into their reserves. Okay, so reduce loans to transfer money, to transfer money for required reserves or reserves in general. All right, which means they have enough money to pay their clients, enough money for depositors, enough money for the clients to withdraw whenever they like. Okay, and that's the whole point of having enough reserves. Okay, now apart from that, okay, if the interest rates go down, then the commercial banks, they borrow more. Okay, so they borrow more money. All right, and they increase or bump their loans up. Okay, so increase loans to transfer money for reserves. All right, so this is number one. This is number two. Okay, and remember that the commercial banks, they prefer the federal funds rate over the discount rate. Okay, which basically means that the commercial banks federal funds rate, they borrow from other banks before they borrow from the central bank. Okay, so commercial banks borrow from other banks, and this could be done overnight. So other banks before they use the discount rate to borrow from the central bank. Okay, so before borrowing from the central bank. All right, so this is your federal funds rate. Okay, this is where commercial banks they borrow from other banks before borrowing from the central bank. Okay, and that would be it for this video. On behalf of Obey Electronics, this is Obey. Have yourself a great day.